Hello, my name is Srikanth Meenakshi. I am with PrimeInvestor.in. In this video, we are going to be looking at mutual fund expense ratios. This is a topic that is widely misunderstood, and people don't really understand how it works, even if they understand what it is. So, in this video, let's look at what it is and how it works. What is expense ratio in a mutual fund? Very simply, expense ratio is the amount that a mutual fund company charges you, the investor, to manage their funds and provide various services like statements and maintenance of records and things like that. And this expense ratio is not something that is very unique to mutual funds. Every financial product that we purchase has some kind of underlying expenses involved. I mean, nobody is providing a free service. There is no free lunch, right? So even an FD, for example, what is the charge that you pay for an FD? Nothing, right? You think so, but inbuilt into the interest rate of an FD, there is a certain amount of fee that is deducted by the bank or the fixed deposit service provider that pays for the services that they offer you, and we always pay for the financial services that we consume. Now, the question is, how much are we paying? How much is it? In the case of mutual funds, which is what we're talking about today, in the case of mutual funds, mutual fund expense ratios are controlled and regulated by SEBI. SEBI is a Securities Exchange Board of India, which is a government body. And this expense ratio rules and regulations are different for different categories of funds, for like equity fund, for debt funds and hybrid funds and so on. And there are upper limits that are placed by the regulator for these different categories. That is, they cannot charge more than a particular limit. And they also have a feature that, as this fund size grows, this upper limit keeps coming down, which means as the fund becomes bigger and bigger, the amount of expense ratio becomes smaller and smaller. Now let's take a very quick look at what these slabs are. Right? These are slab rates. On the first 500 crores, it is 2.25% for an equity mutual fund, and for the next 1,250 crores, it's 1.75, and so on. It keeps going, and on the balance of the assets, it's 1.05%. It's there in the top, but it should come in the bottom. Similarly, for non-equity oriented schemes, the upper limit is 2%, and the lower slab is 0.8%. What we should understand here is that these are slab rates. Every first 500 there is a different charge, the second 500 there is a different charge. It works very much like our income tax rates. These are some of the expense ratios for some of the popular schemes out there. You can see that HDFC Hybrid Equity Fund is a very popular scheme with like 17,000 crores of AUM, has a 1.17% expense ratio. These are for the direct variations. We'll talk about that pretty soon. But these expense ratios that we are talking about here are for the direct plans of the mutual funds. And why do they charge the expense ratio? What goes into the expense ratio? Where does the money go? It goes for providing the various services that we consume as mutual fund investors. It goes for the fund manager. Fund manager has to get paid, right? I mean, he is the guy who is giving us the returns. Fund management expense is the biggest expense, or one of the big expenses. Servicing, right? Brokerage expenses are providing investor services like account statement documentation, and then buying and selling investments in the portfolio. All these incur cost, and this cost has to be borne by the ultimately the investor, who are you and me, right? And there are register and transfer expenses, custodial expenses. They have to market their scheme, and they have to make some profits. I mean, they have to pay rent. There are taxes, GST involved. So all these different expenses, there are about 8 or 9 different expenses that go into what we call as this expense ratio, or TER, the total expense ratio. In US, for example, they have to list out various components. In India, you just get TER, and that encompasses everything. That encompasses all the expenses that an investor pays to the mutual fund company. And we have to also ask ourselves, why are we even worrying about expense ratios? It's a very simple answer, right? Expense ratio is a cost. We are paying for a service and we are getting a service in return. And if we can get same or similar service for a lesser expense ratio or a lesser cost, we should go for that. Every bit of money that goes into the expense ratio comes out of your investment, our investments. So we should be wary of how much money we are spending on this cost, on this expense ratio. I've given an example here. The difference between a 2% expense ratio and a 1% expense ratio, as you can see, over a period of time, it can really grow. But this is assuming that the fund returns, the two funds, Fund A and Fund B, are returning the same 12% every year. That's a very, it's a very imaginative assumption. But just for illustration purposes, I've given a illustration here to say that, what is the impact of the expense ratio. This difference can be substantial over a period of time, and we have to go with the lower expense ratio when we have two funds of equivalent quality. When we think that I can go with either Fund A or Fund B, they are both good funds, which one I should go for? You should go for the one with the lower expense ratio. But that does not mean, I will repeat, it does not mean you should always choose the fund with the lower expense ratio, because you could be investing in a bad fund. So first you have to analyze the funds by quality and then choose based on the expense ratio. And of course, we cannot talk about expense ratio without talking about regular versus direct. In mutual funds, there are two variants for every scheme: a regular plan and a direct plan. A regular plan is when you go through a distributor. A direct plan is when you invest directly or through one of the direct platforms. The difference between these two can be significant. The difference between these two goes to the distributor, and if you can save on that because you make your own investment choices, then you will do well. Or for example, you use PrimeInvestor.in to choose your funds and have a great quality portfolio. You can go with direct funds and save on that, and save on that cost. That cost could be significant, somewhere between like 0.7 and 0.8% every year for an equity fund, and somewhere between like 0.2 and 0.4% for a debt fund. So it could be a significant cost. You should consider that if you are capable of making your own decisions, or if you use a service like PrimeInvestor.in. Now, let's come to the meat of this presentation, the mechanism of expense ratio. How expense ratio actually works. When we buy financial products, the costs are either completely hidden or they are completely open. For example, like an FD, you are never told what the cost is. The bank gives you a 6% FD, and they make a profit of like 3 or 4% on that, and there is hidden cost. That means there is cost hidden in that 3 and 4%, but you yourself, the investor, does not know about that. You just put your money and you get your interest and you go home. There is a cost involved, but that is hidden from you. In the case of stock market trading, go to a brokerage, you explicitly pay a brokerage. You go to like a flat fee broker, you pay like 20 rupees per trade, or you pay like 0.3% or 0.2% per trade, and so on. That is explicitly taken from your trading account. In the case of mutual funds, it's a hybrid. It's a little bit of both. You know exactly what the expense is, but it is not. You don't pay for it explicitly. It is done implicitly, and we'll see how. Now, when mutual funds were conceived and when expense ratios were thought of, the guiding principles that went behind the mechanism was, it should be, first thing is it should be equitable. If there are 1,000 investors in a mutual fund scheme, all of them should pay the same expense ratio. This is a very important principle. And the second thing is, the amount you pay should be in proportion to the amount of time that you invest in that mutual fund. And preferably, it should not be an explicit charge, because explicit charges are very difficult to collect, especially in a very long-term investment like mutual fund. So, 3 principles: same for everybody, proportional to the time frame of investment, and implicit charge. The best way that they found out how to implement the expense ratio is to use something that is fundamental to all mutual fund schemes, and that is the NAV. What is the NAV? It represents the value of the portfolio of a scheme at a unit level. There are like, if value of all the entire portfolio of a mutual fund is like 1 crore, and there are 1 lakh investors in that mutual fund, then the value of the NAV is 1 crore divided by 1 lakh, which is 100, right? So that is the way NAV is calculated. That is a very broad definition of what an NAV is. But this NAV is common for all the investors. It is declared on an everyday basis, and it is implicit, which makes it an ideal vehicle for implementation of expense ratios. Let's take a imaginary scheme. I'm calling it the Prime Flexi Cap scheme. Suppose it has an expense ratio of 2%, and its portfolio is worth 1000 crores, and it has 1 lakh investors having a total number of units of 10 crore units, which means every investor on an average has about 10,000 units of the scheme on an average. Doesn't matter who has how many and all that stuff, but there are 10 crore units of them. Now, when the worth is 1000 crores and the number of units is 10 crores, the NAV is 100, right? As you can see, let's take 1 day of trading, right? Beginning of the day, before expenses, asset value is 1000 crores, number of units is 10 crores, NAV is rupees 100. Suppose this portfolio grows by 5% during that 1 day. It's a fantastic day. Let's assume that. Okay. At the end of the day, the asset value is 1050 crores. And let's assume the number of units stays the same, 10 crore units. Now, the nominal NAV based on these two numbers, the nominal NAV would be 105 rupees. 1050 divided by 10 is 105 rupees, right? But now, let's have to account for the expense ratio. What happens? Every day, the AMC deducts a little bit from the NAV before it declares the NAV to account for the expense ratio. In this case, we assume that it's 2%, right? Typically, there are 250 business days in a year. So, 1 day's worth of expense ratio would be 2% divided by 250. It's 0.008%. So, the NAV that gets declared after deduction of the expense ratio would be 105 minus 0.008% of 105 equals 104.9916 or 104.992. So when you open the paper or you go to the website and look at the NAV at the end of the day of this particular scheme, you will not see 105, you will see 104.992. So it's a very small amount, right? Every day they are drawing a little bit of money from you, but it adds up. But when for them it adds up every day. For the mutual fund company, it adds up every day. At the end of the day, the portfolio value is not 1050 crores now. It is 10,049.92 crores. The difference of, let's say, 18 lakhs goes straight to the mutual fund company for managing this scheme. As I said, the deduction happens in tiny fractions every day. When these tiny fractions are applied to very large 17,000, 18,000 crore portfolios, it's a very profitable business to be a AMC when you have such large schemes. Let's look at some misconceptions about, this is how the expense ratio mechanism works. Let's look at some misconceptions about expense ratio very quickly. Some people think they are charged when you redeem. As we just saw, it is not charged when you redeem. It is when you redeem, you get the NAV that the mutual fund company publishes after taking into account the expense ratio. So you are not charged anything at the time of your redemption. You are actually charged something every single day. We should subtract expenses when we calculate returns. No, you don't need to do that. Every day NAV is published after taking expense ratio into account. So you do not need to explicitly subtract expense ratio or do some complicated math to arrive at your return calculations. Some people think that expense gets charged only when the scheme does well. Please, not at all. Expense ratio gets charged whether the scheme goes up or down every single day. We should always choose. We spoke about this a few minutes back. You have to choose based on fund quality, and finally you can take expense ratio into account, but not initially. Expense ratio are same for all funds in an AMC. That is also not true. Different categories, even within a category, different funds will have different expense ratio in an AMC. And direct plans have a lower expense ratio, so they are always better. They are better on that count, but you have to make sure that the fund is of a good quality, and you need to be able to choose your funds well. And finally, expense ratio is a fixed percentage. No, it's not. It is actually declared, calculated every day, and it's a changing number. It could change through the course of a year. It generally goes through a very narrow band, but it could change through the course of a period of time. So it's not a fixed percentage. So, in summary, expense ratios are very important for people to understand what it is and how it works, because we don't want to have any misconceptions about how our money is being treated and where our money is going. But please understand, expense ratio is not the most important thing when you make your mutual fund decisions. It is an important thing, but you have to focus on quality before you think about expense ratios. So that's it. Hope you found this video useful. Until next time, thank you.